made plenty of mistakes in acquisitions, plenty. The mistakes are always about making an improper assessment of the economic conditions in the future of the industry or the company. They're not a bad lease. They're not a specific labor contract. They're not a questionable patent. Those are not the things that count.
The stock market, a land of dreams promising riches and a brutal reality that chews up the unprepared. Many dive in, eyes filled with dollar signs, only to be left heartbroken and empty-handed. Savings dwindle, dreams crumble, and the sinking feeling of maybe I just suck at life sets in. But wait! Before you resign yourself to financial doom, there's hope. This video delves into the 3 biggest mistakes investors make, mistakes that can easily be avoided. Let's explore these pitfalls and see how you can navigate the market with confidence, turning that sinking feeling into a wave of financial success.
You know, we have $16 billion of cash, not because we want $16 billion of cash or because we expect interest rates to go up or because we expect equities to go down. We have $16 billion of cash because we don't see anything that makes us want to part with that cash where we feel we're getting enough for our money. But we would spend it Monday morning on the right sort of business, or even if we could find equities that we liked, or if we could find, like last year, we found some junk bonds we liked. We're not finding them this year at all because prices have changed dramatically. So we're not really ever positioning ourselves. We're simply trying to do the smartest thing we can every day when we come to the office. And if there's nothing smart to do, cash is the default option.
The stock market thrives on our impulsive urge to buy something with every spare dollar. It's a primal instinct. But here's the harsh reality, the market isn't a giant clearance sale. Not every dip is a fire sale begging you to empty your pockets. Imagine this, you go all in, investing 100% of your cash when the market takes a tumble. Suddenly, you're a spectator on the sidelines, watching juicy opportunities pass you by because you have no ammo left. This fear of missing out can push some investors to even riskier territory. Leverage. They borrow money to buy even more stocks, essentially amplifying their gains, and more importantly, their losses. This financial acrobatics is like tightrope walking over a pit of hungry crocodiles. A sudden market plunge can trigger margin calls, forcing you to sell your holdings at a loss just to repay your loans. On the flip side, if you throw all your cash into the market during a hot streak, you're left defenseless when the inevitable correction hits. There's no cash cushion to average down on your existing stocks, potentially magnifying your losses as the market cools. The key to navigating this financial roller coaster is strategic cash management. The market may be a land of endless opportunities, but your cash is a finite resource. Treat it with respect. By keeping a portion of your portfolio in cash, you become the master of your investment destiny. You'll be prepared to seize the perfect opportunities, calmly weather the inevitable storms, and avoid the emotional roller coaster that comes with being fully invested during volatile times. Remember, a cool head and a well-managed cash position are the cornerstones of building long-term wealth in the market. Don't be afraid to let your cash be your silent partner, waiting for the right moment to strike.
They just don't realize that all you have to do is just buy a cross-section of America and then never listen to people like me or read the papers or do anything subsequently. They think that because you can trade, you should trade. You buy a farm, you buy an apartment house, you can't resell it tomorrow. The cost of moving around. Now you get something handed to you, liquidity, which is instant. You can sell, and the cost of doing it are pennies, compared to other kinds of investment activity. So because they can so easily move around, they do move around, and moving around is not smarter than investing.
The allure of the next big thing can be intoxicating, especially in a world of zero-commission trades. But this impulsive stock hopping often leads to a messy portfolio and meager returns. Fueled by incomplete information and FOMO, fear of missing out, investors chase hot stocks during market highs, only to panic sell at the first sign of a dip. This constant churn creates a whirlwind of buying and selling, each transaction chipping away at your potential returns. Remember, buying is an art, not a reflex. Before hitting that buy button, conduct thorough research. Understand the company, its business model, and the risks involved. Don't just chase the latest hype, be comfortable with the reason you're investing in a particular stock. Once you've done your homework and pulled the trigger, patience is your best friend. Don't let short-term market fluctuations cloud your judgment. Revisit your initial thesis. Why did you invest in this company in the first place? If the fundamentals haven't changed drastically, stick to your plan and let your investment mature. Remember, successful investing is a marathon, not a sprint. Focus on making well-considered, long-term decisions, and avoid the temptation to become a frantic stock-picking butterfly.
Well, Charlie and I don't think about the market, and Ben didn't very much. I think he made a mistake to occasionally try and place a value on it. We look at individual businesses, but the stock market, I know of no one that has been successful at, and really made a lot of money predicting the actions of the market itself. I know a lot of people who have done well picking businesses, and that's what we're hoping to do.
The allure of perfectly timing the market, buying at the absolute bottom and selling at the very top, is a seductive fantasy. But here's the sobering truth: nobody can consistently predict the market's next move. The market's a dynamic beast, influenced by countless factors beyond our control. Investors who chase the elusive peak often find themselves chasing their own tails, missing out on long-term growth while racking up transaction fees. Instead, focus on value investing. Seek out solid businesses with strong fundamentals that are currently trading at a discount. Think of it like buying a quality watch on sale. You're getting a great product at a great price. Through thorough research, identify companies with long-term growth potential that might be temporarily undervalued. Once you've done your due diligence, hold your investment with patience. Short-term market fluctuations shouldn't dictate your decisions. Remember, the stock market rewards those who can think long-term and avoid the emotional roller coaster of market timing. Just like earning a good living requires education and dedication, so too does building wealth in the stock market. It's not a get-rich-quick scheme, it's a process that demands effort and a disciplined approach. By focusing on value, research, and a long-term perspective, you can navigate the market's inevitable ups and downs and position yourself for sustainable growth.